Welcome back to the Deep Dive. Today, we are taking on a contract that sits at the center of financial planning, estate strategy, and often a whole lot of confusion, whole life insurance. When you look at the source material for this one, you realize that the marketing gloss often hides a fascinating and complex mechanical structure.
It truly does. When people encounter the concept of, permanent insurance, the first question they often ask is utterly fundamental.
Oh.
How can an insurer guarantee a fixed contract, a premium that never changes for 80 or 90 years, regardless of what happens to the person's health?
Exactly.
Our mission for you today is to strip away the marketing, deep dive into the foundational structure, explore the guarantees, and, figure out what financial engineering makes this specific type of permanence possible.
Okay, let's unpack this.
Sure.
Our sources provide a wealth of detailed information, clarifying not just the definitions, but the underlying actuarial mechanics.
Yep.
At its core, whole life insurance, or WLI, is a contract that is guaranteed to remain in force for the insured's entire lifetime.
Or until a designated maturity date.
Right, or maturity,
Wow.
provided those fixed premiums are paid. It's designed to be the ultimate contract of lifetime assurance.
That concept of assurance is key. And just to provide some global context, depending on where you are, especially in the Commonwealth, it's often called whole-of-life assurance, or sometimes the simpler straight life or ordinary life. But structurally, the critical thing to remember is that WLI isn't just a policy.
It's a category.
It belongs to the cash value category of life insurance, and this category is defined by the fact that a portion of the premium doesn't just pay for risk, it builds a non-forfeitable equity.
So this group includes things like universal life, variable life.
And older policies known as endowment policies, exactly.
Right, and that takes us immediately to the defining feature and, the immediate pain point for the consumer, the fixed premium.
The sticker shock.
Exactly. This is the moment WLI differentiates itself from its pure protection sibling, term life insurance. It leads to that massive initial sticker shock for young buyers.
It does.
The WLI premiums are fixed. They are locked in stone, based only on the insured's age and health at the time of issue.
And they are explicitly guaranteed never to increase, no matter how long you live.
That guarantee is incredibly expensive to price into the contract early on.
Oh, massively.
Right.
To insure a 30-year-old for, say, $1 million, the WLI premium will typically be 4 to 10 times higher than the premium for a comparable 20-year term policy.
And why? Why is it so much higher?
Because the insurance company knows, with actuarial certainty, that they will have to pay the claim, eventually. Term life assumes they might not have to pay if the policyholder outlives the term.
Here is where it gets really interesting, though, and where the sources demand a deeper look at the long-term trade-off. We often focus only on that initial high cost of whole life.
But that's just the beginning of the story.
Right. Help us visualize the cost comparison over a full life.
Okay, think of it visually. If you were to graph the premium paid over time, the whole life premium is a flat, predictable line, a high plateau from day one. Term life, however, starts near the floor, and then it begins climbing, slowly at first, but then it accelerates almost vertically as the person enters their 60s, 70s, and 80s.
So the fixed cost of WLI avoids that catastrophic jump in price late in life.
It completely avoids it.
And the mathematical implication of those two different curves, one starting high and flat, the other starting low and spiking, is the core actuarial insight.
Exactly. Our sources highlight a critical concept. Because term insurance premiums rise so dramatically with increasing age, eventually becoming, prohibitively expensive, leading to most people dropping the coverage.
Right.
The cumulative value of all premiums paid under both whole life and term policies is actually calculated to be roughly equal if the policy continues until the insured reaches average life expectancy.
So if you live to 85, the high, flat WLI premium structure ends up costing you about the same total dollars as the low to exponential term structure.
Where less,
You're just pre-funding the high-risk years.
That's the perfect way to put it. Pre-funding the mortality risk. The actuarial trade-off is this. Term offers cheap, temporary coverage when your risk is low, but forces you to bear the massive financial burden when your risk is high.
Whereas whole life demands that higher contribution early on.
To guarantee the affordable rate late in life, it's a pricing decision designed to smooth the massive cost spikes inherent in aging.
So our mission today is to break down the mechanics of this pre-funding. How does WLI take those high early payments and use them to simultaneously guarantee a lifetime death benefit and function as a source of guaranteed tax-advantaged liquidity.
Mm-hmm.
We need to understand the financial engine operating beneath the surface of that fixed premium.
Let's do it.
Moving into the core mechanics, let's start with the intended payout, the death benefit. Assuming the policy is paid up or premiums are current, what determines the final amount delivered to the beneficiaries?
Mm-hmm.
It's rarely just the stated face value, is it?
That's correct. The foundation is always the stated face amount, the figure you signed up for, let's say $1 million. But that figure is the starting point.
It's subject to adjustments.
Right. Several important adjustments which can significantly alter the final payout. And these adjustments are determined by the policy's structure and how the policyholder has managed their cash value.
Okay, give us the positive adjustment first.
The primary positive adjustment comes from what's called the participating factor. If the policy is a participating whole life policy issued by a mutual company, which we'll get into later,
Good.
the death benefit is increased by any accumulated dividend values. Many policyholders elect to use their annual dividends to purchase what are called paid-up additions, or PUAs.
And what are those exactly?
They're essentially tiny, fully paid-for, single premium policies that are layered on top of the base policy.
So they increase both the face amount and the cash value every year. So the death benefit can actually grow substantially over time.
Yeah.
That $1 million policy could easily pay out $1.5 million or more, depending on dividend performance.
Absolutely. Now, the second adjustment, which is negative, is crucial for anyone using the policy for liquidity. The loan factor.
The loan.
The death benefit is always decreased by the total amount of any outstanding policy loans, plus any accrued interest that hasn't been paid back.
So if you took out $100,000 as a loan against the policy and never repaid it, that $1 million payout immediately becomes $900,000.
Instantly. And finally, we should note that various riders, like an accidental death benefit or a waiver of premium rider, can also influence the final number.
You've contrasted the structure with universal life, or UL, before. If both are cash value policies, how does WLI's death benefit stability differ from UL's flexibility?
What's fascinating about UL is the inherent flexibility it offers. UL policies can be structured, often it's called option B, to pay the cash values in addition to the face amount.
Which sounds great.
It sounds appealing because the death benefit increases dollar for dollar with the cash value accumulation. However, and this is a big however, the source material explicitly notes the consequence.
Which is?
These structures typically sacrifice the lifetime coverage guarantee. WLI, by design, focuses ruthlessly on the stability of that lifetime guarantee, meaning its cash value is almost always inclusive of the death benefit, not in addition to it.
That distinction lifetime guarantee over increasing death benefit is central to WLI's purpose. Now, let's address a fascinating but increasingly relevant issue. Policy maturity. The insured lives to a ripe old age and the contract ends before they die.
Yes, the policy matures at death or the stated maturity age, whichever comes first. This is a crucial historical point. Traditionally, most whole life policies set the maturity age at 100.
100.
Specifically, the policy anniversary nearest age 100. The underlying assumption actuarially was that virtually no one would live past that date.
Okay, stop right there. This is our aha moment and a critical potential tax trap for listeners who own older policies or who are planning for extreme longevity.
It really is.
If the insured lives past age 100 and the policy matures, what happens?
This is a major liability for the policyholder. The policy becomes what's called a matured endowment. Because the contract guarantees payment at age 100, the insurance company is obligated to pay the face amount in cash to the policy owner.
Okay, so you get a big check.
You get a check for $1 million, which is great, but that payout fundamentally changes the policy's tax status.
How so?
Since it wasn't a death benefit, the difference between the cash you received and the total premiums you paid is taxed as ordinary income.
That's a huge potential tax event, undoing one of the key benefits of the insurance. You were essentially punished for living too long under the old contract terms.
It's the ultimate irony of increasing longevity. To address this looming issue, which became a real threat as more people started routinely hitting 90 and 100,
They had to do something.
most modern whole life policies issued since around 2009 have dramatically increased the maturity age, often to 120.
Wow.
This adjustment is specifically intended to preserve the tax-free nature of the death benefit, ensuring the contract only concludes upon death, thereby guaranteeing the tax-free status of the payout.
So they push the goalposts back 20 years to keep the tax promise intact. That brings us to the core engine that funds this longevity, the level premium system.
Right.
How does this system allow them to charge a fixed rate over 70 years when the mortality cost is obviously skyrocketing later on?
This is the genius of actuarial science and the foundation of the WLI contract.
Hmm.
The system operates on a calculated imbalance.
Imbalance.
During the insured's younger years, say from age 30 to 65, the policyholder consciously overpays for the actual risk of dying during those low-risk periods. This excess capital, this prepayment of risk, is what is accumulated and reserved.
And that accumulation is then deployed later.
Precisely. That early surplus is used to underpay for the expense of insuring that same person in their later years, from age 75 onward, when the actual mortality risk is exponentially higher.
So the fixed premium is not a reflection of the current risk.
Not at all. It is an average of the risk across the entire lifespan, actuarially flattened for the client's benefit.
So those early overpayments are absolutely fundamental to the structure. What is that accumulating surplus actually called?
It generates what we call the cash value reserve. And it's essential to understand that this reserve is not some bonus or an added savings account.
It's a requirement.
It is a required, mathematically necessary component of the contract design. Without that reserve, without that prepaid pool of capital, the insurer simply could not afford to pay the death claims for individuals who live into their 90s, having paid the same fixed premium as they did at age 40.
And this leads us directly to a fascinating macroeconomic implication. The role of these reserves in the broader financial world. These aren't just funds sitting passively, are they?
Not at all. This is where state regulation comes into play. U.S. life insurance companies are mandated by state law to set up these massive reserve funds to account for these prepaid future obligations.
And that requirement is what leads to the designation legal reserve life insurance companies.
That's the one. And critically, these reserves, these enormous pools of capital, are classified on the company balance sheet as liabilities.
Wait, I want to emphasize that for the listener. The money they paid in, the money that funds their cash value, is a liability to the insurance company. Why should the listener care about that accounting designation?
It reinforces the absolute guarantee of the contract. The money is classified as a liability because it represents a future obligation legally owed to the policyholder or their beneficiary.
It's a debt.
It is debt the company must service. This distinction, a huge asset pool, legally classified as debt, is what underpins the safety and security of the contract. The company is legally required to hold sufficient high-quality liquid assets to meet those liabilities.
And the scale of these legal reserves has a massive impact on the economy.
It really does. The visible wealth of the life insurance industry stems from the immense assets they hold to back these future liabilities.
And by regulation, they have to invest it conservatively.
Primarily in highly conservative instruments bonds, high-grade corporate debt, and other long-term debt instruments. This makes legal reserve life insurance companies one of the largest yet least discussed sources of fixed income financing for both government and private industry globally.
Because their long-term fixed obligation forces them to be massive, stable capital allocators focused on debt financing.
Exactly.
Let's transition now to the feature that motivates most purchasers, the cash values themselves, the guarantees they hold, and the strategic tax advantages they unlock.
Right. As we have established, cash values, or CV, are just inextricably linked to the policy's core function. They reflect the mandated reserves needed to guarantee that fixed lifetime death benefit.
They're the policyholder's equitable share of the prepaid risk pool.
That's a good way to put it.
And what financial rights do these cash values give to the policyholder while they're alive?
They grant two primary non-forfeitable rights, which stem directly from the contract design. First, the right to terminate the contract and reclaim a share of the reserve fund.
That's the cash surrender value.
Right. And second, the right to borrow against that reserve fund, creating the policy loan value.
I want to address the marketing perspective versus the mechanical one. We've heard the common marketing pitch. WLI is a death benefit with a savings account. Our sources, quoting actuaries, often push back on that, calling the savings analogy artificial.
They do, because mechanistically, the cash value feature is a byproduct of the actuarial need for a level premium structure, not a separate, intentionally designed investment vehicle.
But the human psychology is undeniable.
Absolutely.
Right.
While people buy WLI out of the fear motive of protecting their family, they often maintain or expand it due to the greed motive, the thought of being able to access and count their own money in the future.
Well, the source material notes that policies purchased at younger ages will usually see their guaranteed cash values eventually exceed the sum of all premiums paid.
After a number of years, yes, which reinforces that sense of ownership and return.
That guaranteed accumulation is critical, especially in a volatile market. Let's focus on the security features of the cash value. What is the guaranteed growth profile?
This is where WLI provides genuine financial stability. Cash values grow at a rate that is contractually guaranteed, typically around 3 or 4% in older policies, plus an annual dividend if the policy is participating.
And the critical part is the guarantee.
The CV is guaranteed to increase every single year, regardless of whether the company has a bad year on its investments or sees a spike in death claims.
4% might sound low to a listener comparing it to the stock market, but what makes that guaranteed rate valuable even when it's low?
It's a non-correlation factor. This cash value pool is built for certainty, not aggressive returns. It provides a conservative floor that will never decrease due to market downturns.
Big ballast.
It's a ballast to a larger, more aggressive portfolio. It's not designed to compete with the S&P 500. It's designed to always be there, reliably compounding.
And that security extends to asset protection, which is extremely valuable for certain listeners.
Absolutely. This varies significantly by state, but in many U.S. jurisdictions, cash values are afforded significant, sometimes 100% asset protection. Meaning that the money stored within the policy is shielded from civil lawsuits, creditor claims, or personal bankruptcy proceedings. This makes WLI highly attractive for professionals in high liability fields like doctors or small business owners.
Anywhere where personal asset protection is paramount.
Exactly.
All right, let's dive into the liquidity and tax strategy. This is arguably the most crucial detail for listeners interested in the financial engine of WLI, the policy loan advantage.
This is key.
We need to break down the 3 key tax rules.
Okay, rule number 1 is the foundation, the death benefit. Under current tax code, the entire death benefit, including all internal gains from cash value growth, is generally received by the beneficiary free of income tax.
That's the ultimate promise.
That's the promise.
Rule number 2 covers what happens if you want the cash value while you're alive.
Right. Rule 2 addresses surrender. If the policy is cashed out, meaning surrendered or elapsed before death, only the gain over your total premiums paid is taxable as ordinary income.
Your total premiums paid being your cost basis.
Your cost basis. So if you paid in $100,000 and the surrender value is $120,000, that $20,000 gain is taxable. It's a financial disincentive to just cash out your policy.
And now, rule number 3, the strategy that provides tax-free liquidity in life. If I need $50,000, how do I get it out without triggering rule 2?
You utilize the loan strategy. Most financially savvy policyholders choose to take cash values out not as a surrender or withdrawal, but as a policy loan against the death benefit.
And this money is entirely free from income tax.
As long as the policy remains in force, you are essentially accessing the money tax-free.
Help us understand why the loan proceeds are not taxed. It sounds too good to be true.
It goes back to the core structure we discussed. Because the ultimate payment, the death benefit, is non-taxable, the policy loan is simply treated as borrowing against a future tax-exempt event.
The insurer is just advancing money from the non-taxable future proceeds.
That's all it is. When you die, the outstanding loan balance is simply subtracted from the death benefit, and the net proceeds remain tax-free.
So there's no immediate tax consequence, but there is a crucial caveat if the policy lapses.
Absolutely. This is a critical detail. If the policy is surrendered or lapses later on, perhaps because you stopped paying premiums, any outstanding loan amount that exceeds your cost basis,
Your cumulative premium paid.
will then become immediately taxable as ordinary income. The IRS is basically saying the loan was tax-free based on the promise of a tax-free death benefit. Since that promise failed, we will now tax the gain you took out.
So it's a powerful strategy, but it requires diligent maintenance of the policy.
You have to keep it in force.
You also mentioned that for participating policies, the dividend structure can soften the blow of the loan interest.
That's a major value add. When you take a policy loan, the insurance company charges interest, usually a reasonable rate.
Sure.
However, if your policy is participating, the annual dividends you receive can be allocated to offset the loan interest, or in some cases, the dividend might actually exceed the interest charged.
So it effectively neutralizes or significantly reduces the cost of borrowing your own money.
While allowing your policy's remaining cash value to continue compounding tax-deferred. Yes.
In terms of practical access, how liquid are these cash values? Are we talking weeks or days?
They are extremely liquid. They are considered highly liquid assets because access is guaranteed by contract. A policyholder can initiate a loan or withdrawal simply by calling the insurance company.
Or submitting a request?
And the funds are typically transferred to their bank account within a few business days. Compare that to selling a piece of real estate or liquidating a complex investment fund.
That guaranteed quick access also allows for crucial financial planning uses, particularly for those large single premium policies.
Yes. Single premium WLI policies, which are paid up with one large upfront payment, are instantly liquid and inherently financially secure.
Which means they can be used immediately as collateral.
Right, for large commercial or private loans through a process called collateral assignment. The bank accepts the policy as collateral because the cash value is guaranteed and easily liquidated if the borrower defaults.
Now, let's tackle the biggest myth in life insurance, one that causes immense confusion: the disappearing cash value myth. The idea that when the insured dies, the insurance company keeps the cash value and only pays the face amount. What's the reality?
We have to dismantle this carefully because it misunderstands the core relationship. The reality is that the cash values are considered to be inclusive of the death benefit.
Not in addition to the death benefit.
They are the funded portion of that ultimate payout. Think of the policy as a pre-funded liability account. The insurer has been reserving money, the cash value, for 70 years to meet that future obligation.
So using an analogy, the cash value isn't a separate, secret vault of money the insurer steals.
No.
It's the money that paid for the funeral, so to speak.
Exactly. Imagine buying a guaranteed, fully prepaid ticket for a very expensive future event. That ticket is the cost of the event. The cash value is the accumulated cost basis plus gains necessary to guarantee the event of the non-taxable death benefit.
So the insurer pays out the cash values with the death benefit because they are essentially one and the same.
They're inclusive of each other. This is precisely why the policy loans are non-taxable. You're borrowing from the funds already reserved for the non-taxable death payout.
That reframes the entire discussion and clarifies why the contract is structured this way. Finally, let's address the estate planning context, the tax shield.
Right. While life insurance proceeds are generally income tax-free, they are not automatically free of estate tax in the U.S.
Which can be a significant issue for a wealthy individual.
A huge issue. Under Internal Revenue Code Section 2042, life insurance proceeds will be considered part of a person's taxable estate if that person possesses incidents of ownership in the policy.
What specifically constitutes an incident of ownership? Help us understand the practical scope of that term.
Incidents of ownership refer to any economic control you have over the policy. This includes the power to change the beneficiary, the ability to surrender the policy for its cash value, or the right to borrow against it.
So if you have any of these rights, the IRS views you as owning the asset.
And it becomes subject to estate tax upon your death.
So if the policyholder is wealthy, they must surrender control to keep the policy out of their taxable estate.
Correct. That's why estate planners often step in and utilize highly specialized structured trusts, most commonly the Irrevocable Life Insurance Trust, or ILIT.
And the ILIT owns the policy.
By having the ILIT own the policy from inception, the policyholder legally gives up all incidents of ownership, ensuring the proceeds bypass the taxable estate.
Fulfilling the dual goal of income tax-free and estate tax-free transfer of wealth.
That's the goal.
Let's shift gears now and explore how the structure of the insurance company itself fundamentally affects the policy's pricing, guarantees, and potential returns. We're deep diving into the two major pricing philosophies.
Right. Non-participating or non-par and participating or par policies.
This distinction is entirely centered on risk assumption and ownership structure.
It is. Since whole life policies are long-term contracts, potentially spanning half a century or more, the challenge of pricing accurately is immense. Actuaries have to set a rate that is sufficient to maintain company solvency across every possible economic and mortality cycle.
And how a company manages that margin for error determines the type of policy. Let's start with non-participating, the simpler of the two.
Non-par policies are typically issued by stock companies, entities that are owned by shareholders. For these policies, all critical values, the premiums, the death benefits, the cash surrender values,
All fixed.
they're fixed and determined precisely at issue. They cannot be altered. The contract is a hard number.
So the insurance company assumes the full risk of future performance compared to its initial actuarial estimates.
Exactly. If the company's estimates prove conservative, if their investments outperform the projections, or if death claims are lower than anticipated, The company retains all of that excess profit, or surplus.
And it goes directly to the stockholders.
Right. And conversely, if the company underestimates claims or faces investment losses, the company has to absorb the entire burden, drawing on shareholder capital. The risk and reward are borne entirely by the company owners.
Now compare that to participating, or PAR, policies, which are often synonymous with traditional WLI from older established companies.
Right. Participating policies are typically issued by mutual life insurance companies. These are fundamentally different because they are owned by the policyholders themselves.
It's a mutual structure.
So the policyholder shares directly in the company's excess profits or divisible surplus through annual dividends.
I want to focus on the dividend mechanics. Why are the premiums for PAR policies often initially higher than non-PAR policies, and why are the dividends themselves tax-free?
This is key to understanding the mechanism. The premium for a participating policy is intentionally set higher than what the insurer expects the true cost of insurance will be.
This is the overcharge.
Right. It's commonly referred to in financial literature as an overcharge, which immediately acts as paid-in surplus. This intentional overcharge creates a margin for error, a safety buffer.
It's the equivalent to the risk capital from stockholders in a stock company.
That's a great way to think about it.
And the dividend is simply the refund of that overcharge.
Precisely. The dividends are tax-free because the IRS views them, technically, as a refund of that premium overpayment or a return of basis.
And the dividend reflects the company's favorable experience.
Across three major factors: better than expected mortality, excess interest earned on investments, and savings and operational expenses.
That system has led to some remarkable historical performance, especially for long-standing mutual companies. I want to expand on the note about the 1980s and 90s.
This historical context is vital because it showcases the potential power of the PAR structure. During the high interest rate environments of the late 80s and early 90s, the interest component earned on the company's general account assets skyrocketed.
Wow.
Consequently, the annual dividend paid out to policyholders sometimes grew large enough to exceed the policy's entire annual premium at the 20th policy year and beyond.
So after 20 years, the policyholder was essentially getting their premium payment covered, and then some, by a tax-free refund.
Effectively, yes. While current economic conditions mean such scenarios are rare today, it illustrates the policyholder's direct participation in the company's success.
It shows that when investment returns are robust, the PAR policyholders directly benefit.
Whereas in a non-PAR policy, that profit would have been locked away for the shareholders. The policyholder takes on slightly more risk via the higher initial premium, but they get the upside participation.
Finally, let's look at a policy variation that attempts to bridge the gap between fixed non-PAR and market-sensitive PAR, the indeterminate premium policy.
These are often issued by stock companies. They offer a mechanism similar to non-PAR in many ways, but with one crucial modification. The premium may be adjusted year to year.
Which allows them to set competitive rates.
Right. Based on current economic and mortality conditions, it makes it feel more like a PAR policy without the formal policyholder ownership structure.
But does it maintain the fundamental WLI guarantee?
Absolutely. The key safety net remains intact. The current premium rate can fluctuate, but it will never, under any circumstances, exceed the maximum guaranteed premium stated in the policy contract.
So it's an attempt to offer market-based efficiency while preserving the underlying guarantee of permanence.
That's it.
Moving on, let's ground this technical discussion in real-world application. When, specifically, is whole life insurance the ideal choice? When is it the indicated financial tool?
WLI is dominant for ensuring permanent insurance needs, those obligations that do not disappear over time.
Things like?
Because of its lifetime guarantee, it is the appropriate vehicle for needs like covering inevitable funeral and final expenses, funding major long-term estate planning objectives, providing guaranteed income streams for a surviving spouse that must last decades,
And using those tax-advantaged policy loans to supplement retirement income.
Exactly.
So it's for needs that run co-terminal with the insured's life. When is the high cost of WLI a deterrent?
It's a poor fit for temporary needs. Because the premium is so high to pre-fund the later years, WLI is generally not attractive for situations like covering a 15-year mortgage, ensuring children's dependency years, or securing a large amount of coverage for a young family with limited income.
If you need $2 million in coverage for only the next 20 years?
Term life is significantly more economical. The utility of whole life shines only when the need is truly permanent.
We often focus on personal uses, but businesses have incredibly complex permanent financial needs. What are the key business applications that specifically mandate cash value insurance?
We identify four major areas. First and second are the classic risk indemnification needs: funding buy-sell agreements between partners and indemnification for the death of a key person whose expertise is vital.
Okay.
Third and fourth are executive retention and benefit plans, funding supplemental executive retirement plans, or SERPS, and funding general deferred compensation plans.
You drew a sharp distinction earlier regarding the first two versus the last two. Why can term life often suffice for buy-sell and key person, but cash value insurance like WLI is mandatory for SERPs and deferred comp?
The difference lies in the purpose. For buy-sell and key person indemnification, the business simply needs a large, fast influx of cash if someone dies now.
And term life provides that pure, cheap risk coverage.
Right. But deferred compensation and SERPs are fundamentally different. They are designed as executive retention tools and future funding mechanisms.
Explain how that structure makes WLI or other cash value insurance mandatory.
Deferred compensation and SERPs rely on two things term cannot provide: guaranteed, tax-deferred accumulation, and guaranteed liquidity.
So the company needs a mechanism to set aside money today that grows predictably for decades.
To cover a future contractual liability to the executive, WLI provides that predictable cash value accumulation, often secured by the company's general account.
And the liquidity.
The ability to access that cash value via policy loans provides the company or executive with tax-advantaged liquidity during the policyholder's working years without triggering immediate taxation,
Term life only offers a death benefit, no accumulated value.
making it useless for these long-term benefit and retention plans.
That makes perfect sense. The permanence and accumulation aspect is the product, not just the death benefit. Now let's look at how the basic WLI structure is modified. We have several key variations, starting with limited pay policies.
Limited pay policies are designed for people who want the lifetime coverage guarantee but hate the idea of paying premiums into their 80s. The goal is permanence without perpetual obligation.
So premiums are only due for a set number of years.
Right, 10, 20, or until age 65, for example, but the coverage remains fully in force for life.
The structural trade-off must be a much higher annual payment during those limited years.
Substantially higher. The initial premium is significantly increased because the insurer must build up the necessary cash value reserve much faster.
To ensure the reserve is large enough to fund the mortality cost for the remaining decades when no premiums are collected.
Exactly. And if the policy is participating, those robust dividends can often be used to shorten the premium paying period even further, potentially making the policy paid up years ahead of schedule.
Then we have the most concentrated form of limited pay: single premium policies.
A single premium whole life policy is paid for entirely with one large payment made at inception. This provides immediate funding and maximum liquidity from day one.
They're financially secure, no risk of lapse.
And, as we noted, they are instantly liquid enough to be used immediately as highly reliable collateral via collateral assignment.
But a massive payment up front must come with some penalty if you change your mind early on.
That's the commitment trade-off. The source material notes that these policies typically carry significant surrender fees during the early policy years. If you surrender the policy too early, you may incur substantial charges that reduce the cash value you receive.
It ensures that the policyholder is serious about the long-term commitment.
It does.
Finally, we arrive at interest-sensitive whole life, which sounds like an attempt to capture some of the market responsiveness of universal life while maintaining the certainty of WLI.
That's a perfect description. It's often called excess interest or current assumption whole life.
So like traditional WLI, it guarantees a constant death benefit for life, and it always has a guaranteed maximum premium.
Right. The key difference is the cash value growth. Instead of growing at a low guaranteed rate plus a variable dividend, the interest credited to the cash value varies with current market conditions.
So it offers the structural guarantees of permanence and a maximum premium, but injects a degree of performance upside into the internal savings component.
Exactly. The premium may vary year to year, similar to UL. allowing the company to pass on favorable current mortality or expense savings to the policyholder. But the guarantee that premium will never exceed the maximum stated in the contract preserves the core WLI safety net.
Which differentiates it sharply from UL policies, which often lack a guaranteed maximum premium and are designed to lapse if performance falters.
A critical distinction.
That brings us to the synthesis of our deep dive. We've moved from the high initial cost to the complex actuarial engine, the guaranteed cash value reserves, the critical tax advantages provided by the policy loan strategy, and the structural variations.
The foundational takeaway for the listener should be that whole life is a contract defined by its certainty and its fixed long-term obligations.
And these contracts necessitate the existence of massive reserve funds.
Classified as liabilities, which in turn generate those policyholder rights to cash surrender and loans. It is a highly specific tool for permanent financial needs, often used in conjunction with sophisticated tax and estate planning.
Now, we must address the ultimate trade-off, the internal rate of return, or IRR. We discussed that traditional participating WLI cash values are invested in the life insurance company's general account. How does that generally affect the IRR compared to policies that are more market correlated?
The source material is quite explicit. The internal rate of return for traditional participating WLI may, over the long run, be worse than that of universal life or interest-sensitive WLI.
Whose cash values are often more closely linked to current money market or bond fund rates.
Right. This is the direct cost of structural certainty.
So you are essentially sacrificing potential high market returns for guaranteed, predictable growth and ironclad security, the non-correlation factor we discussed earlier.
Precisely. For the owner who requires a conservative, non-volatile position for their cash values, perhaps as their designated emergency or opportunity fund, traditional par WLI is indicated.
And we must juxtapose this certainty against the risk inherent in the alternatives.
We do.
What's the ultimate risk of those alternatives?
The sources offer a blunt caution. Universal life policies are noted to run a much greater risk and are actually designed to lapse.
Designed to lapse.
This is often because UL policies calculate their minimum required premium assuming internal performance that frequently doesn't materialize. When the actual crediting rate falls short, the policyholder is forced to pay a massive escalating catch-up premium to keep the policy from lapsing.
Whereas whole life strength is its structural design that makes it nearly impossible to involuntarily lapse, provided the fixed premium is met.
It has to remain in force to fulfill its lifetime promise.
And the company has to be structured to withstand any potential volatility over those 70 or 80 years.
That is the ultimate non-negotiable contract commitment.
That necessity of guaranteed permanence leads us to our final provocative thought for you, the listener. We've established that WLI policies require incredibly complex actuarial estimates to price accurately over a 50 to 90-year window estimates spanning future mortality rates, interest environments, and operational expenses.
The solvency of the entire company rests on those estimates remaining sufficient through every economic and social upheaval.
So given that life insurance companies are the largest stable investors in the world, what factors, not explicitly mentioned in the policy contract, such as future revolutionary improvements in human longevity that dramatically increase payout periods, or sudden, severe global shifts in the political and regulatory landscape that affect how reserves must legally be invested and managed, pose the biggest long-term threat to the guaranteed nature of these cash value reserves and the lifetime promise itself?
A fascinating and existential question.
Something to mull over as you weigh the price of financial permanence.
It underscores the immense challenge of pricing a contract that promises to outlive the issuer's initial projections.
Indeed. Thank you for joining us for the deep dive. We hope you now feel completely informed on the inner mechanics of whole life insurance.